If you've ever wondered why so many investors are looking at the Midwest to invest today, this episode is for you. Today, we're talking to a build-to-rent specialist who's going to share why this market is so hot right now. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today, we're talking to Andy, who runs the Kansas City and Wichita team that Real Wealth works with. We'll talk about what's driving job and population growth across the region, why new construction rentals are appealing to investors looking for stability and ease, and how build-for-rent communities are meeting the needs of today's long-term renters. Also, if you want to learn more about the Midwest markets, just visit realwealth.com/Kansas City. Andy, welcome to the Real Wealth Show.
Hey, it's great to be here.
So let's talk about the Midwest. It's kind of a funny thing. Whenever the coastal markets are challenged, it seems like the Midwest just takes off. And right now, that seems to be where people want to invest. So when did you start investing in the Midwest?
So it's funny, as you can see in the background, I'm not in the Midwest right now. I'm actually in Florida where I live at, but continue to invest in the Midwest principally as our markets. Started out there in the real estate business. So Kansas City was the first market I'd ever done anything in. I spent a lot of time in kind of that, Kansas, Missouri, Arkansas, Oklahoma, Midwest type markets, if you will. And we still do a lot in the Kansas City and Wichita markets. There's a lot to like. They don't tend to overheat. They don't tend to kind of be the bubbles that traditionally you see along the way. And I think in the environment that we're in right now, the steady growth is really appealing to a lot of investors.
When you say overheat, you're not talking about the temperature because it gets hot there, right?
This is true. This is very true. Yes. From a market conditions point of view, I mean, you can look at some of the markets that are really experiencing pain right now. So, your Austin, Texas, or your Nashville, Tennessee, or some of these others that, had tremendous double-digit growth for years throughout kind of all of the COVID period, even pockets of Florida significantly, that you just saw that growth that had to at some point either retrench or flatten out or whatever else. And I think, we're still seeing rent growth. We're still seeing 3% plus rent growth, if not 4 or 5 sometimes in those key Midwestern markets where you're seeing a lot of popularity there now. I think because in theory, they're somewhat undervalued still. You're still seeing an affordability access there. And the industries that are there are really, really, I think, future-proofed in a way that maybe they aren't in some other areas. They're less dependent on white-collar employment. I mean, we really, really like the markets, specifically in Kansas City and Wichita, both because of the amount of manufacturing, the amount of logistics, the amount of aerospace, all the different kinds of things, freight, all those aspects to it that, candidly, they're a little bit harder to be replaced by AI, right? They're not just the white-collar jobs that are making $200K a year that might be quickly replaced. There's physical elements to it. They're heavy on the infrastructure side. You don't go in and just, build an entire ecosystem of fabs and manufacturing sites overnight. So because of that, they're very, very difficult to move. So those jobs tend to be much more resistant to some of the future technology trends that we're seeing now.
I don't know. I've been seeing some robots pick up heavy things. No,
This is true.
But they're expensive. And that's the thing. It's human labor is probably a little bit less expensive than a bot, at least maybe not over the long haul. And we'll probably see more and more robots coming into these positions. But I agree with you. At least I've heard that a lot, that the white collar jobs may be lost before the blue collar.
Yeah, I think in this wave, I mean, I spent earlier this week, I was actually at a big industrial conference looking at industrial asset management with a lot of the leading groups in that space. And there's a sense of the jobs that will be enhanced by AI and the jobs that ultimately might be in danger because of AI. And I think when you look at, the onslaught of maybe robots or other types of things or automation even, the jobs that are left are actually higher paid jobs. They're actually very desirable jobs. So from an economic development point of view, when you talk to a lot of these communities across places like the Midwest or really anywhere in the country, they're looking at it and saying it may not be 1,000 jobs, but those 200 jobs that are making 150 or 175K a year are really key people that we would love to have in our community versus, hey, yeah, we're losing some of the guys who are maybe unloading trucks or unloading boxes without any assistance at $20 an hour. So it just changes, I think, the economics of kind of where those jobs are going. where they're going to be at. And, ultimately, once you kind of have the really expensive infrastructure, the technology in place, the hardware, if you will, it's not easy to move it. So I think, the communities that have a head start on that already, you're seeing a clustering effect where if there's already a bunch of manufacturing there, there's going to be additional manufacturing that wants to be close to that other manufacturing because of the efficiency that goes into it. So we consider all those things when we think about housing, because those are a driver of who your tenants are going to be in the future.
And just the transportation systems. I mean, the Midwest is mid. There's a reason that is in there, and so a lot of that distribution and transportation, it goes through there, and that's not going to change. People are still going to need the stuff they want, and it can't all be made by robots. But you have to be careful investing in the Midwest because it's like a slow and steady market. Like you said, it's not going to be in Austin. It's not going to be in San Francisco with these boom and bust cycles. It's slow and steady. But you can get into neighborhoods or parts of the city that are either high crime and it's not going to perform well for you, or there's just no growth. There's just kind of nothing happening, and prices will never go up. And therefore, when you have big CapEx, you have big expenditures that have to be done on a property, it just wipes out your cash flow. So how do you make money over the long term in the Midwest, in places like Kansas City, where again, you've got to know your neighborhoods?
Yeah, I totally agree with you. And I think that's why we really have been drawn to doing more build for rent communities versus kind of your scatter site approach. The scatter site requires just tremendous amounts of local expertise. It's like on the east side of the street, you're good. On the west side of the street, you're not, those types of things, if you will. So when we look at a site, on a site selection process to potentially build like a build for rent community of townhomes, duplexes, single family rentals, whatever it might be, we're looking at school district number one. I think school districts are huge. I think they drive a lot of where people want to be at in terms of desirability. With the product that we're building as well and investing in, it's mostly families. It's not going to necessarily be your transient, worker who's in town for 6 to 12 months and kind of on to their next thing. There's a stickiness to school districts and really highly rated school districts that's very desirable. Your kids are going to school with their friends, and you're less likely to kind of, uproot them and take them somewhere else for $100 a month, right? Like that's not going to be as likely. So school district number one, and I think, number two, then we really do look at like proximity to kind of the jobs or the job growth or the types of jobs that are there. So we're very much looking closely at the median income of kind of your submarket. So, all markets are not equal, but even within an MSA, all submarkets are not equal. So we're very much looking at that. We're trying to kind of find those little pockets where, for example, the submarket that we're really high on in Wichita, Kansas, is $94,000 a year median income for the household. And you're looking at that pocket saying, that's not representative of all of Wichita, but that's representative of the submarket where all of our product is going in at specifically, because it's there. And that household income is, again, reflective of there because they really desire that school district and that proximity to kind of the various things in town that are important to them. So I couldn't agree more with you. I think there's a local expertise that you want when you're really looking at this. The value for us, though, of being able to do development and really approach it from more of a build for rent lens is you can build that community that that a lot of folks are going to value in terms of being a tenant, but then also on the other side of it, it creates a multitude of investment opportunities for real wealth members and other folks like that you're not going to get if you're just kind of finding the ones and twos here and there, if you will, that are more infill oriented. Big believer in, again, greenfield, path of growth, where things are going, and not having to try to kind of convince people that this is a great neighborhood to live in, just build houses where they already want to be at anyway.
Yeah, I love the idea of newer homes in these Midwest areas because people might go online and see an older home that's really cheap and not really understand, as we talked about, what that neighborhood is. Are there jobs nearby? Does this home come with an enormous amount of deferred maintenance that you're going to have to deal with? And the answer is yes, right? Generally, unless it's been fully renovated, but that's not usually the case. And it might be just a lipstick renovation that you're just going to have to deal with a lot of issues. So to get something newer, it's still pretty affordable to build in these areas. And if you're planning on holding for the long term, it's just better to have new. You're going to have a lot less things break down on you over time. So great model.
Sure. I mean, I think our favorite strategy as well is even, kind of depending on how you define the long term, we only do new construction. We only recommend that because you get the 1-year builder warranty. So you know that ultimately you're going to kind of work through any of the initial kinks that might be happening in terms of the home or how it was built or whatever else along the way. And we love the 1031 strategy. We love the idea of saying, every 3 to 5 or 6 years, you can trade out in some way, in a meaningful way. It's a fantastic part of the tax code that I think is underappreciated or underutilized in a lot of cases. And, you're never the guy value adding that property or kind of going in and saying, I got to replace the roof and the HVAC and the foundation issues or whatever else. You're always in a spot where somebody else is kind of doing that after you are, when they own the property in the future, if you will. So again, also a big fan of new construction when it comes to these things.
Yeah, I love new construction. One thing that we've always been cautious about is if there's too many rentals in one neighborhood. And I see more and more build to rent communities. We have our own build to rent community in San Antonio that we're putting together and managing it all under like a horizontal apartment. But when you have a lot of different owners in one neighborhood, that could be problematic if it's not managed properly. So how do you make it work, and what are your tips for having a lot of investors in one neighborhood? Yeah.
I think you really have to kind of, as much as anything else, you're doing diligence, obviously, like you should on anything else on the community and the neighborhood and the area. But it also, to some degree, you're also then at that point kind of vetting the management company, right? The manager of a build for rent community is that key element. It's important always who's managing your properties ultimately. But if you have a central management company that's involved in the development of it even and has been there from the beginning, it really becomes less competitive to the neighborhood. Like, i.e., my 3-bedroom, 2-bath, 2-car garage house is competing against the one down the street. If they're all in the same neighborhood, they're kind of actually coming online and leasing at different times in a way where nobody wants to devalue their property. Nobody wants to give away concessions they don't have to. Nobody wants to lower the rent and, establish lower comps. So it really kind of, I think in some cases, helps avoid that race to the bottom that you'll see sometimes in scatter site areas where there may just be a few things and all of a sudden you have the unforeseen foreclosure down the street that just blows up your comps with the bank, or the Airbnbs go in across the street and all of a sudden nobody knows what anything is worth, right? So there's elements to, I think, the build for rent aspect, as long as it's well managed, where again, you are seeing everybody kind of aligned in their incentive, if you will, to make sure that you're maintaining the value. I mean, it's one of the reasons that whenever we're doing a build for rent community, we're almost always putting in some type of an HOA or CC&R to be able to kind of have that control piece. And it's easy enough, I think, to see that as like, oh, that's a cost to me. And we've had that conversation many times with folks. But I think to understand that it's also then removing other line items and protecting the value of the home in a lot of ways. And we look at our communities and say, do you really want to be dependent on someone who's paying you $1,600 or $1,700 a month to be mowing their lawn every week? Because, when the next guy comes in to release that next property, the neighbor's yard looks like a mess. It's like, that's not a great thing. So all those kind of central elements that, again, are part of an HOA, whether it's, snow or grass or landscaping or trees, or even to an amenity level, pool, clubhouse, trails, all those things, I think, create a more premium renter experience. And the more the market is shifting towards renter by choice, the more I think those things become very, very important checkboxes in your own investment strategy.
Yeah, HOA is a great, to answer my own question, it's a great way to put rules in place, because nobody's stricter than the HOA, right? Even HOA is going to be tougher than your property manager.
It's the ultimate kind of, and at times I think, people read horror stories about, situations, and usually they go back to more owner occupant type neighborhoods that get incredibly involved in everybody's lives to a degree that maybe is even inappropriate in one way or another. But an HOA by its very nature is there to protect the owners of those properties, right? So it's there to make sure that, again, the grass and the trees don't look terrible and things are taking place and, the sidewalks aren't all cracked and all these kind of various elements. There's just kind of a minimum threshold that gets established. And I think when you're in a scenario where at some point you're going to lose that tenant and you're going to have to release and get another tenant along the way, you don't want the wild card of, I hope they show up in the neighborhood on a day where it looks good versus it looks terrible, from an impression point of view. It's consistent. It allows for, again, kind of a professionalization, if you will, of how those properties are being managed. And I think there's an efficiency and a scale in all of it as well, because the folks who are responsible for that are responsible more at that HOA property management level than just an individual hoping that their renter is behaving themselves and then having to kind of, be the kindergarten teacher stepping in and kind of asking them to, to do better. It's not fun.
No. So in an area in the Midwest, we don't maybe see as high growth as maybe the Southeast has been. So when you bring on new supply, you want to make sure you're not oversupplying, right? How do you monitor that? How do you know that you're not overbuilding?
Yeah, I mean, it's a great question. And I think, again, the value of kind of approaching it where you have control over the entire community initially as more of a developer hat than just kind of a broker hat gives you the ability to be that in that position, right? So if you think about it from the point of view of someone who's developing a build for rent community, anything that they haven't sold yet already or finished is ultimately kind of on their own balance sheet in some form or fashion. So the motivation to dump 50 units or 100 units in the market in a month, and all of a sudden, nobody can lease up or you can't get the absorption you want, is actually even more detrimental to whoever that developer is than it is to the individual owner or investor in that community. So
Yeah.
we're very, very mindful of it. We view it as, there's a gas pedal and there's a brake. And we want to be, our leasing folks have more power than people realize to just say, hey, we're going into winter right now. It's seasonal. We may only get 5 leases a month for the next few months because who's wanting to move in Thanksgiving or Christmas?
Yeah.
But, when we come back in the spring, we're popping, we're going to be do 20 leases a month. So let's just make sure that we're not dumping too much product on the market right now in a way that, again, undervalues or devalues in any way what's happening here. So I think you have to be mindful of the numbers for sure. And there's a value, again, in kind of having a vertically integrated team to be able to have construction folks talking about how many COs do we have coming up in the next quarter versus leasing or asset management folks determining, again, where are rents at? Are we having to talk about concessions? Are we getting more inquiries? Where are we kind of going in that direction? So there's a lot of different teams, I think, that are all professionally managed, being able to coordinate with one another with the intent of, again, creating the most value for everyone involved in the process. So, it doesn't work if you're just one of those pieces. It works if you kind of have an overarching ability to have those different pieces of the equation kind of also answering to you.
We know there's a lot of reshoring happening, or at least that's the intent of all these tariffs, is to bring manufacturing back to the US. Are you seeing some of that? Are you seeing certain areas that are growing faster than others?
Yeah, absolutely. I mean, I kind of mentioned, we track the industrial world very, very closely because I think it will be a driver of, AI resistant jobs or jobs that are not as, as in danger, if you will, along the way. I think the reshoring piece, until tariffs kind of stabilize to some degree, there isn't going to be as much as we will see at that point once they kind of stabilize. But there has been a lot of reshoring, onshoring, or new fabrication or manufacturing facilities being built over the last 5 year plus before tariffs were even in the conversation, candidly. And I really wanted to understand why that was. And so about 2 years ago, I started really deep diving around this subject. And I came back over and over again and actually spoke to a lot of, European companies, Latin American companies, even Asian companies that were looking at either building new fabs in the US or having built, new fabs in the US. And it was really more the proximity to kind of that North American market. The fact that the North American market is, by all intents and purposes, the most valuable consumer market in the world. So it was wanting, from a supply chain point of view, to be closer to their customer, if you will, to be less disruptive, to be less dependent on everything having to come over on ships in case we have another pandemic or something of that effect, than it was even the tariffs. Now, I think the tariffs, once they settle down, will also add an additional financial incentive or pressure, if you will, for folks to kind of put more of that into the US. But I can tell you, compared to a California where you're at, or even where, South Florida where I'm at, New York, New Jersey, there's a lot of these areas that traditionally have been very popular for manufacturing and logistics and all the various other things that are incredibly expensive compared to that Midwest market, where you have a lot of eagerness and local incentives. I mean, you can look at, I think, the Midwest and the Southeast will probably be the two regions that benefit the most by far from any movement towards onshoring or reshoring or whatever you'd like to call it, because they have an available workforce, they have a motivated local governments, when it comes to incentives and all the various things, they have available land. I mean, think of the price of land in some of these other places where you're competing against all these other asset classes. You might need 100, 200, 300, 400 acres of greenfield to go put in, the warehouses and the fabs and the cross docks and all the other aspects to those types of projects. That's difficult to find in a lot of the markets of the US, but I think it is readily available, again, kind of in your Midwest, Southeast markets.
Yeah. Okay, so we have a lot of Californians, some East Coasters too. They're in high-priced markets. It makes no sense to have investment property in these in San Francisco or LA. You're going to
Yep.
be cash flowing, but negative cash flowing, not positive. So, right. So we have a lot. We just did a live event a couple of weeks ago, and a few people showed up with properties that are either negative cash flow or they've just been a money drain, which is really difficult to evict someone in California. There's new laws. I just discovered, we're kind of in an eviction situation right now. And if the person is a senior, it's really, really, really hard. I actually have to move them, even if they're late on payments. You have to pay for their next place. Like it is very difficult. So a lot of these people were saying, we just want to buy something somewhere else that's easy and get out of California being a landlord-friendly place. So let's say one of those people had $1 million house paid off, rental property in LA, and they want to 1031 exchange it somewhere else. What advice would you give them?
I think, everyone looks at diversification from a couple different ways, but I think when you look at, moving into product that can still be new construction, but at price points that probably are going to be very surprising, if not shocking, to those folks who are moving out of multi-million-dollar properties in LA, for example. I mean, we look at, duplexes all the time on new construction that are sub $500,000 for the entire building. So that's 2 units, each of them paying you roughly an average of $1,800 a month, with much closer to a 30% expense ratio than a 40% expense ratio, which you'll find in Texas and other places with higher property taxes. We love the Midwest markets. They're 1.25% property taxes. 1.25% is your rate. It's very, very small when you compare it to the other things that kind of go into it. And so, if you can move in and you can have tenant in place scenarios, effectively you're moving into cash flow day one, right? Tenant in place, lease signed, fresh leases in most cases, with new construction and still your warranty ahead of you. It helps to mitigate the risk. I mean, obviously anything that's involved in real estate, there's still going to be, your diligence and your process of kind of thinking about it. There are obviously things that can go wrong. I mean, you mentioned evictions or other types of things, and those are unfortunate circumstances or situations. I think when you're going though into product that's more like a B plus, A minus, you deal with that a lot less, candidly, because you're underwriting to higher income levels, higher credit scores, no history of eviction in the past. I mean, don't get me wrong. There's always that surprise one where someone's life circumstance, behavior just changed, and you're like, I didn't see that coming. But, you don't want those to occur because of poor planning or poor execution or poor management. You want them to occur because they're just 1 out of 1,000 or 1 out of 10,000 or 1 out of 100,000 where it just became a weird circumstance. But I think in the case of looking at, areas where you do have more landlord friendly, laws and scenarios, you don't want to, lose your cash flow for a year because someone isn't paying you rent or more.
Yeah.
You want to be able to expedite that process. And we typically, within a few days of them, either not communicating or not paying rent along the way, are beginning that process. And that might be a 30-day process in the Midwest. It's not going to be, 300 days plus, where it can be. I know in some of these just horror stories that I hear along the way. So I think, mitigating your risk as much as possible where it makes sense is the best thing you can do. Nothing is perfect. Nothing is a 100 for 100 or 1,000 for 1,000. But I think, the closest you can get and the smarter bets you can make, the better you come out in the end in terms of where you're at. That's where we really, really do love the Midwest markets. There's just a competitiveness to it that is really, really difficult to find in other areas that are orienting their whole focus towards the tenant and the tenant rights and the tenant situation. And I think, you have to handle all these things with compassion and professionalism. But at the end of the day, the people who are buying these properties, who are investors, they worked very hard to be able to, save money and be in a position to be an investor. And, their rights also are very important to be able to be defended in those cases.
Yeah. So if you are selling a property for $1 million, that means you need quite a few properties that you need to acquire and identify in 45 days. When you identify new property, if it's not built yet, that can be a little bit terrifying because if it's not done in time, you don't get to do the exchange and you end up paying taxes. So do you have product available for people that they need it and they need to identify it right away?
Yeah, absolutely. And in most cases, we always have tenanted property as well. So, you're not
Mhm.
just looking at new construction that's already been completed in the last 30 or 60 days. You're also looking at new construction that may already have a tenant who's already moved in and paying rent or moving in within the next 30 days. So
Mhm.
I think that's the important of kind of having a pipeline of new construction opportunities is it does allow you to be timely with those 1031 exchanges and not be in a spot where, it gets stressful when you're at day 40 and you haven't figured out exactly where you're going with that, and you're wanting to avoid the tax bill. We totally understand that. We work with 1031 investors all the time and recommend, again, that is such a key part, I think, the strategy along the way. So, yeah, very, very comfortable with saying at any given time, we have opportunity with, completed construction, tenanted in a lot of cases, opportunities to come in and to be able to make the move. I think, the 45-day time window is usually more than enough for us. And then it's just a scenario of when they're ready to close after that.
Great. Yeah. No, people are asking that all the time.
Mhm.
So if it was you and it was your property that you had one, sort of underperforming older property, it needs lots of work. Just when you were saying to 1031 into something new, it's like a breath of fresh air to me to get out of a dog, into a
Yeah.
beautiful, shiny, brand new product. We've helped thousands of people change their lives overnight because of that, getting rid of old properties that aren't performing, getting into new ones that are. If you were advising somebody, how would you recommend they diversify? Which
So,
markets would
so
you choose?
Yeah, I mean, obviously, I'm going to be biased to say, Wichita and Kansas City are the two markets that we work in the most ourselves. But I would even say Wichita over Kansas City right now, and for a couple
Mm.
different reasons. And you can split the difference. You're always able to say, okay, I've got several properties I can purchase here. We're just seeing a stronger rent ratio in Wichita than we're anywhere in the country, and I'm very mindful to look at other people's deals all the time, every day. I always want to know what else is out there and what opportunities are out there. The markets that are on their way to 1 million people in terms of an MSA from a population point of view that have the right fundamentals like a Wichita, but the institutional capital has not discovered them yet, are going to have a rent ratio and a cap rate available that's just impossible to achieve in a market where you've had a significant amount of Wall Street money chasing it for the last 5 or 10 years, right? So I
Hmm.
think those differences are really, really significant. So I would say, that for them to optimize, they're going to look at several duplex, buildings that they could ultimately purchase well within their 1031 at that point. That new construction, builder warranty, tenants in place, cash flow day one, yeah,
Yeah.
and know that 3, 4, 5, 6 years from now, as Wichita continues to grow, if institutional capital ever discovers it, they're going to have a tremendous pop. They're going to have steady growth. They're going to still be in the 3, 4, occasionally a 5%, annual growth in terms of the value of the property. But if you see the institutional capital come in, and by that I mean, again, the big buyers, the larger kind of
Yeah.
again, Wall Street entities come in, it just changes the whole dynamic because they're going to be buying up everything, and they balance shift that whole supply demand scenario in terms of what's available in the market. We love the idea of getting there early, but not too early. I mean, it's always the kind
Hmm.
of the thing, right? It's like, I know sometimes we're early, but you don't want to be so early that you're wrong. And I
Yeah.
think, again, when you're in that scenario of kind of thinking within the next, 3, 4, 5 years out, there's still plenty of opportunities in those Midwestern markets. Wichita is my favorite right now. I love Kansas City as a market. We still always have, offerings there. We're still building. We're still leasing up. We're still selling. We're still buying. I mean, all those things are taking place still. But I love the Wichita market. I was just there last week. I flew up and spent a couple days there, and just was very, very impressed with not just the product, how it's coming out, the amount of inquiries, the amount of just what's driving that market felt very, very strong, and it felt again from a timely point of view like, okay, we got here on time. I've been early before and I've been late before, but it felt like we're getting there on time for Wichita.
I love that. Yeah, because like we've got a wonderful product in Chattanooga that a lot of people have been, buying, and it's performing really well. It's already on the map. It's like people are already flocking there and driving prices up, and it's getting harder and harder. But Wichita, I feel like, isn't quite there yet. So yeah, I agree with you. It's still an opportunity. Well, thank you so much. Any final comments for our listeners?
Oh, it's so good. Obviously, talk about this kind of stuff. We're always happy to have a conversation. I think that, the Midwest is having a moment, but I think it's going to be a long-term, I think, growth strategy in terms of where it goes with everything. And again, we love those AI resistant jobs. We love owning property in places where the landlords have very, very strong protections in place. And we love build for rent communities with those protections that also kind of protect the entire community and align everyone's incentives. So love to help people get into stuff, love 1031 exchanges. And again, appreciate everything you do, Kathy, and your team.
Thank you. Thank you so much for sharing your wisdom here on The Real Wealth Show.
So much.
Thank you for joining me here on The Real Wealth Show. And again, if you want to learn more about these properties, if you want to buy a brand new property in the Midwest with property management in place and a tenant in place, just go to realwealth.com/Kansas City. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show, and we'll see you on the next episode.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.